advanced credit appraisal and risk assessment techniques. In today's dynamic financial landscape, so this webinar is brought to you by Elite Bankers Club, a community dedicated to fostering professional excellence and leadership in the banking sector. Shri Kalia's experience in banking sector is both deep and extensive.
Clearly observed that nowadays things are moving very, very fast technologically. Addition to the banking system for the purpose of coming out with an informed credit assessment decision. So this is very, very important for us to understand what are the risks that are associated, which have to be identified and mitigated in the context of the credit appraisal. Because all banks are providing similar kind of product services to various category of borrowers. The selection of the borrower is proper, you are going to have it wrong 100%. So selection of the borrower or looking at the borrower profile, going through its CIBIL score, going through other data that is available in the public domain and taking a decision. And then, so that is the kind of model that is being used for all kind of, retail loans that are being made available by the banks. And there have been so many committees that have been set up for the purpose of coming out with various kind of recommendation as to how we should finance which category of borrowers. And they have not been wished away, irrespective of the advanced techniques and tools that are being used by the banks currently for the purpose of making credit assessment. Credit working capital assessment requirements of borrowers having limits of projected annual turnover, which is accepted by the bank, that is made available to these kind of, small enterprises, small borrowers. And what is done under these methods of lending is you take projected level of current assets and you take projected level of current liabilities other than bank borrowings. That is to be financed fully from the long-term sources, and 25% of the remaining projected level of current assets is to be financed by long-term sources. So that is the three methods of lending that were prescribed, but mostly for the purpose of assessment, it is always the second method of lending that is being employed by the banks for the purpose of coming out with working capital assessment. Corporate borrowers also, and when we will talk about CMA data that are required to be submitted, even at that point of time, you will realize whatever is remaining to be available, if the borrower has net working capital, of course, not that other credit, there are, nowadays banks' balance sheet is mostly constituting of RAM sectors. So retail, agriculture, MSME are very, very important. And I have briefly touched about that. But then really emerge for the banking system is in respect of the corporate credit, and their credit appraisal of requirements of the corporates are very, very important. And we will talk about that. That whenever a corporate comes out with any request for either enhancement in working capital or for initial sanction of working capital or for any kind of term loan requirements, they have to come up with what we call CMA formats. And you are probably aware that there are 7 formats which have to be provided by the corporate customer to the bank for the purpose of carrying out any kind of credit appraisal for his projected for the plan. But primarily, these formats are used for the purpose of working capital assessment, not that they are not made use of for the purpose of term loan requirements of the customers, of a borrower. When you have to do credit appraisal, it is not only analysis of the financial statements. About that profile has to be done, what is the rating and all that. External ratings have to be done. We have to make assessment about that. Nowadays, 5 crores and above, all borrowers have to be rated externally also by one of the approved credit rating agencies that you are aware of, which is about the risk that may emerge. And if they say it is a AAA rated account, so to that extent, it really helps the banks to take informed decision. And this also is directly linked to the credit pricing, right? So Non-financial assessment from all sources. We will glean through all records. We will take FCU report. We will go through databases, whatever is the market reports available on the borrowers. And there are nowadays so many, agencies which are making available. So these kind of technological, which were earlier not being used, are being used. Now for financial analysis, you need not do analysis manually, but methodology for the purpose of taking a decision would continue to remain more or less what was there earlier also. These would be the additional, tools that are available at the hands of the lenders to take a well-informed decision. Now, I thought before coming to the financial analysis, I should talk about non-financial things, which is very, very important. And that is where all these internal scoring rate models that we have got and external ratings come into play. And we have to go through all kind of, information available about a borrower. So these formats are taken from the corporates and which is giving particulars of limits which the borrower is having, what is the outstanding and what is the projected level of limit that he is seeking. Then he will give us operating statements, which we call projected profitability statements, which will get data for last 2 actual years. Current years would be estimates and next years would be estimated. So that analysis would clearly indicate as to how the funds are being generated and how they are being employed, whether use of funds, and that is liability is always a source of fund and assets are always use or application of funds. So this fund flow statement has to be made available, which is very, very important tool available for the purpose of carrying out credit appraisal. And then, of course, there is a ratio analysis that has to be done. And why ratio analysis is very important? Because that is how you evaluate. Suppose, if somebody is requesting for working capital, what is very important ratio for us to look at is the current ratio. What it indicates? That higher current ratio would indicate that most of the current assets of the borrower are being financed not from current liabilities other than bank borrowings, but from long-term sources. Whatever has come from the long-term, which is capital or reserves or whatever is contributing to the net worth, if most of the current assets are being financed, a crisis. So that is current ratio, quick ratios and all, quick ratio is generally, but current ratio is very significant for working. But when it comes to the question of term loan, then all these debt equity ratio, what is net worth to total asset ratio, what is fixed asset coverage ratio, what is interest coverage ratio, all these things have to be seen at that particular point of time. So these are different kind of ratios that have to be taken into consideration for the purpose of assessment of any term loan requirements. And when we do the credit appraisal of any term loan, whether it is by way of sanctioning of term loan or by way of sanctioning of a deferred payment guarantee arrangement, which also goes to finance the term loan requirements of any corporate borrower. Right. So this is, these 7 statements which we get from the customer, which we analyze and then come out with our credit appraisal. That this is how we can particularly, on the basis of the data provided, we will do the credit appraisal assessment and make available to the extent acceptable to the bank as per the norms laid down, go on financing a particular borrower. Because then if something goes wrong with that particular borrower or his financial condition, bank would be very adversely affected. So second most important thing that has to be taken consideration of is concentration risk. That has to be always done. Whatever happens geopolitically is very, very significant to the operations of the corporates within the country also. And these factors have to be taken into consideration and they have to be embedded in the credit appraisal framework that we are going to work out. So this is the kind of, scenario that we will have to work out. And when we do the term loan assessment for our corporates, I mean, I can also say that working capital is only about analysis, coming out with certain level of acceptable limits, making available. But term loan project, whenever you have to do the credit appraisal of a term loan requirement, it requires a very, very, very detailed study. Financial viability is something that has to be seen very, very minutely, because we will have to go into the entire projected profitability estimates. We will have to come out whether the unit would be able to generate sufficient internal accruals that would not only service the interest that has to be paid by the borrower on the term loan, but also services the due installment which are payable for repayment of that particular term loan. That is going to be a little problematic for the purpose of continuing servicing its debt obligations over different economic cycles. You would have seen, those who have dealt credit in their professional careers, that economic scenario of any unit can't keep on changing. Why I'm talking about all these things is that these are small, small things, but which have to be kept at the back of your mind while doing term loan appraisal. Because in case any of those scenarios emerge, that these are kind of factors that have to be taken into consideration for the purpose of assessing the working capital, term loan requirements, making credit appraisal both in respect of working capital as also for the purpose of term loan, right? These are the methods that are always being employed for these purposes. But the topic that was that what is the advanced credit appraisal, right? That was the topic, and what are the risk assessment techniques that are being used. As I was mentioning earlier also, to enhance the accuracy of credit, evaluations, examining a borrower's, spending habits. Similarly, on predictive basis analysis, whatever, scoring models are being developed by, so many FinTech companies with whom banks are collaborating. It would be very important for us to go in for what we call tie-up with FinTech company, financial technologies company, which have invested in thought for the purpose of coming out with these kind of, predictive analysis, which will, we can make tie-up with them and help us to improve over this credit appraisal techniques, advanced, and make use of these advanced credit appraisal techniques. If I go back to the time when I joined the bank and the kind of techniques that are being now employed for the purpose of credit decisioning, even in PSBs, and mitigating all those risks while doing credit underwriting or what we call credit appraisal. That can be effectively mitigated, according to me, if we have a robust credit monitoring mechanism. Would enable you to take proper corrective action and protect the health of the particular borrower account. Actual essence of any loan sanctioned after whatever level of due diligence, whatever you may do by way of your assessment, that is always in any other aspect that you wish me to speak. Thank you so much. Back to you, Mr. Arvind.
And before we come to the most important, most valuable part of our session, the live interaction.
To ask
Okay.
questions. So my
Okay.
request is we can do that subsequently. Let's first give the chance to the
Okay.
participants.
And after that, we'll open the floor for our participants to ask their questions. So friends, our next webinar will be on next Sunday, 22nd June. And the topic will be the metaverse and its implications for the banking industry. The session will be taken by Shri Sunil Soni, a former Chief General Manager of Punjab National Bank and a whole-time member of. Then on 29th of June, we have a session on SME lending, driving growth and managing risk. This session will be taken by Dr. Fareed Ahmed, former Executive Director, Punjab and Sind Bank.
Sir, can you explain the procedure in short, the project CC when you are lending to the particular project?
Now that is very, very basic for infrastructure companies when we finance infrastructure companies. whether what kind of liabilities that will fall on that particular agency which has given, or the agreement that has been entered into by our borrower with the agency which has given that particular contract. That is something which is very, very relevant for us to peruse. Road projects. That is why infrastructure financing, resulted in so many gross NPAs, because the obligation that were to be fulfilled. So these are the kind of peculiar risks which helps. But can we avoid being a public sector bank financing infrastructure project? The answer is probably, when there is so much of need to develop infrastructure in the country, at least we as public sector banks have to come forward. But we have to strengthen our inbuilt suitable safeguards, that the kind of NPA that we have encountered in the past by financing, they do not reoccur.
Just I want to convey that what should be the opportune time for exit from industry, because in the given data available, it is found that there are many takers of a credit uptake in when the industry is on a very high boom period.
Try to just shut its door on the borrower and say, now you repay by exposure, because then in that particular case, you have to review your risk assessment strategies. Suppose I am saying a particular industry is going downside. There is a prudential limits fixed for taking exposure on textile industries, jute industries, technology industries. We fix, prudential limits. But under no circumstances we can shut our doors on any borrower just because a recession has set in that particular company.
Okay, so my question is not restricted to the reaching recession level. Just I want to understand there is a time in every industry when there are so many takers in the market to finance a particular industry or particular stake. But as a credit monitoring or as a risk management officer, there is always opportunity for a banker to exit at a time of safe conditions. So can we define any such condition when a credit manager or a credit risk officer should think on exiting a particular unit or industry?
Absolutely right. If you feel as a risk officer that there is this kind of scenario is developing in this particular industry where it is safe for us to exit, if you are a private sector lender like ICICI, HDFC, what you will do, you will immediately put in place a mechanism. If prudentially for a public sector bank, what we will do, where we feel in a phased manner, we would like to reduce our exposure in that particular account. We will work out an action plan. So those risks that are associated with the project per se would remain. That would not undergo a change, accepting that the impact of those risks manifesting would be felt less in a HAM project than in any other form of financing. That's my take.
By requiring the auditors to specify key financial aspects after examining thoroughly. It includes both tangible, intangible assets, loan transactions, internal controls, legal compliance, whistleblower compliance, defaults companies properly, whether management has visited those assets. So we will come to know about advanced due diligence sitting in our office if we insist the Caro report from the companies. This is one aspect I wanted to tell beyond the balance sheet and profit and loss account what it is required. Big loans, you have to look into the contingent liabilities like statutory dues and any other, because we are very much interested in knowing the cash flow, because that is the source for repayment of our term loans, not the profit. So cash flow will be affected if there are some contingent liabilities which are definitely going to be.
But exposure management you can do, sir, only through that, because individual entities will have different configuration of finance.
Correct.
But on the whole, in deciding the sector, you can see how the sector is performing, and that is why, sir, a couple of things only. First is peer industry analysis. whenever we are financing, because all entities will have their own business cycles. So we have to always keep in mind what is the stage at which this particular entity is, and what is the prospects, and how FDI and FII funds are coming into, and how the sector is going to perform in the next 5 to 10 years, which we used to get after 2 years. So in that case, what refinement you can do, perhaps we can customize them at our level, depending upon our experiences with the particular kind of industry. So a lot of research is to be done by the entities themselves in managing the credit risk.
Then lending for working capital, lending for say term loan, and borrower profiles are changing, technology is changing, regulation is changing, banking laws are changing.
Sure.
Then naturally one has to be very adaptable to the situation to keep pace with the development. You know, we have a lot of prudential regulations, micro-prudential, macro-prudential, where actually it will go bad. So credit monitoring is playing a very big role that Kalia Sahib has also explained that at what point of time a very good borrower will turn a non-performing asset, we don't know. That's why credit monitoring is also important. And if consortium lendings are going bad, the level of NPA in the system level will increase suddenly. So private companies are coming to commercial bank for loan, and commercial bank is not in a position to do anything because government is the say
Correct.
counterparty. In case of big lending, big borrowing, this is one aspect that and banker is also at their wits end because they cannot go against the government. And in many cases, diversion of funds leads to non-performing assets. But most of the cases, they divert the funds for some other use. Because if you have a listed company, you have at least 300-400 step down subsidiary. Sometimes, you know, end use of funds become very difficult. Ensuring the end use of fund becomes very difficult. That leads to what is called non-performing asset, and the bankers are sometimes find it very difficult to catch hold of this kind of people. So these are some of the things actually which came to my mind, that these things are very important from the point of view of financial stability, or their major liability to a particular bank. That bank will be in trouble if all 20 borrowers, big borrowers, they are facing problem at some point of time, either because of diversion of fund, or because of counterparty credit risk, or because of economic slowdown that Mr. Srinivas Rao has told. They have to exercise caution at every stage of the credit cycle, as well as the credit history.
Mr. Ishan, I think, wants to ask another question.
So what a branch head and a board, because you guys have headed the branches also and you have represented the boards also. Very good counterparty with minimum spread, or a moderate counterparty, maybe triple rated or A rated, with a decent spread of 1.25%. What we should focus as a youngster, what you will guide me?
I think none of us would be in a position to say that you should focus only on AAA rated counterparty. But are you pricing that risk appropriately in your risk pricing? That is something we should be more cognizant, rather than just thinking about whether it is a AAA or a AA. Sir, Dr. Srinivas, you know,
Yes, sir.
when we introduced that credit approval grid committee concept, okay, you cannot come out with any corporate credit proposal without a review of the industry, or without a peer review comparison. That has to be there. And the entire node, you would have seen many times, used to be a big node which would contain all information, not only about the industry pertaining to our borrower, but also about peer.
And made valuable additions to the discussion today. And as we conclude, please note that the full video recording of this webinar with a video summary and key takeaways, and I warmly invite you to consider joining the Elite Bankers Club.